Welcome to the Business with Beers podcast. This is the place where we help entrepreneurs expand their business, build their wealth, and generate passive income. I'm your host, Brian Beers, an entrepreneur who's on a mission to inspire growth from everyone around me. Remember that you need to take the actions others won't, and you can live the life that others don't. Please be sure to check out my weekly newsletter that now drops every Thursday. It includes one quote, one tweet, one podcast recommendation, plus some business and investing insight from me. It's short and it's sweet. My goal is to provide you with just a couple gold nuggets to help inspire your growth. Go to brianbeers.com to subscribe. Hello, everyone. I'm excited today to bring you Mike Flaherty. Mike is the founder and managing partner of a private equity real estate fund that manages over 1.3 billion with a B properties under management. Welcome to the show, Mike.
Hey, thanks, Brian. It's an honor to be here and looking forward to going through some stuff with you.
Awesome. So can you take us back to whenever you started, maybe kind of the beginnings of your career, to kind of lay the groundwork of how we kind of got to where we're at today?
Yeah, it's a good question and a long story, in a long road with lots of rights and lefts and changes and ups and downs and failures and successes along the way. And I'll start from the beginning, and you take me wherever you want. But I have always been a real estate guy. I remember in high school seeing land and having my father pull over in the car and asking him, "Hey, what could I do here?" I always had this interest to envision construction and development on certain properties. I just didn't know how to do it. My grandfather was a builder, helped me make things as a kid. And I really thought, to some extent, I wanted to go down that path. It took me into civil engineering as a college degree at Villanova University in your hometown of Philadelphia, Pennsylvania. And started in the civil engineering world, designing, entitling, mostly commercial projects for the likes of McDonald's, ExxonMobil, Rite Aid, Walgreens, Walmart, you name it. And it was just a really phenomenal experience in the business.
So you go to college for that, civil engineering, then you get this job, corporate job, working on these big projects like right after college.
Yeah, no doubt about it.
These big Fortune 100 companies, like.
Yep.
Okay.
Exactly. And as an example, I was responsible for getting securing not only the design of the properties, but the approvals through planning commission, zoning hearing boards, city councils.
Oh, so you were taking this ball to the end zone, getting the whole thing ready from design to then approved to then I guess the architecture is then going off and building the building.
Correct. And securing building permits and then turning it over. I did a lot of work for McDonald's as an example. And we were a third-party consultant for McDonald's. We would do all this work, get it approved, hand over building permits, and let them
go off and build it.
I did that for the likes of McDonald's and many others in my early 20s when I really didn't know what I was doing. It was kind of baptism by fire, and probably did, upwards of 200 plus projects over a short period of time, mostly in the mid-Atlantic, Brian, from Washington, D.C. up to, New York, New Jersey area.
Okay. Yeah, sure. The 95 corridor there. So then what? What happened after that?
I thought I wanted to do commercial real estate.
Okay.
And I learned after a couple years of battling angry neighborhood groups and challenging city councils that this wasn't exactly a lot of fun. So I went into residential, which is what I really thought I wanted to do. And I worked for Toll Brothers, one of the largest national luxury home builders in the country, also out of the great city of Philadelphia, as you know well, and managed a number of very large master plan communities outside of Philadelphia. One of which won Community of the Year in Chester County, called Euclid Woods. It takes you back a long ways. And did that for a couple years and realized, hey, this wasn't really what I wanted to do either. dealing with potential homeowners all weekend, and were unhappy with their staircase one week after moving in. Was not for everyone, but it was something I always wanted to do, and I learned a ton.
Yep.
That's another phenomenal company for getting, what people call your masters in residential real estate development, surviving Toll Brothers for 2 years. And then I wanted to go back to commercial. I worked in New York City at the time, was with the third largest fee development and construction company called Bovis Lend Lease. It was a global conglomeration between Bovis, a large project management construction company out of London, and Lend Lease, one of the world's largest REITs out of Australia. And we had a global alliance with British Petroleum. So we were doing all of BP's construction, entitlement, development internationally. And I was tasked for running that out of New York City.
The whole team,
I enjoyed that.
Internationally.
Correct.
Okay. And building like the gas stations, or building like the pipeline, like the infrastructure side of it?
Good question. It was considered downstream work, which is retail. So the gas stations, the convenience stores, I helped them roll out the first retail designed hydrogen fueling facility at LAX and Los Angeles. So that was a phenomenal experience. BP bought Arco Oil on the West Coast. I transferred or moved out from New York City to the sunny and beautiful beaches of Southern California, and did the same for Arco out there, managing their development from Seattle down to San Diego.
Okay. All right.
And all the while, I really wanted to learn how to go out and do it on my own, Brian. I was garnering all this great experience and building a track record in hopes that at some point in time I would become my own, or have my own entrepreneurial spirit and startup. And I was doing a little bit of everything, or had done a little bit of everything, because I wanted to do that.
Yeah.
Also, while I had the job with the BP Global Alliance, Bovis Lend Lease, I was taking my dollars and saving my dollars and investing in personal real estate. So I was buying single family homes across the country, buying small duplexes, fourplexes, and getting my feet wet, essentially, and learning how to get it done on my own. All while trying to figure out what did I really want to do and how to make money. I knew how to build and design and develop. Didn't necessarily know how to make money doing it. That led me to want to get my MBA. So I applied for my MBA at USC and UCLA. I ended up going to USC while I still had a job. And we're developing Arcos, gas stations, convenience stores on the West Coast. And had met some really successful real estate guys at USC. There's a plethora of them. And two of them in particular took me under my wing and basically said, "Hey, Mike, you're ready to jump. You're not going to learn much more. It's time to jump and do this on your own." So I did that I was halfway through getting my MBA at USC. I did this probably 2015.
Okay.
Partnered. What's that?
And so you got the job, and they're saying, "Hey, quit your job, go full time into real estate."
Yeah, and it's what I'd always wanted to do, right?
Yep. Yeah, that's where your passion lies.
I saved up some money. I bought all these little single-family homes and duplexes and triplexes and fourplexes, my plan was that, hey, all the cash flow that I'm generating over here will help support my entrepreneurial startup over here.
Yep.
Unfortunately, that didn't work out when 2008 hit. But I did jump. I partnered with some really bright investment bankers out of Southern California. We did some development in New York City, Southern California, Los Angeles, San Diego area. And I was on my own. I partnered with Thomas Schuss, who's a famous interior designer out of West Hollywood. We were flying around on helicopters and landing on deserted beaches and in Costa Rica and Dominican Republic and Puerto Rico, looking to build boutique hotels or condo hotels. And then 2008 hit, right? Lehman Brothers failed on September 17th. I almost remember the date of that year. I had an office condo project that was pretty much beachfront in Hermosa Beach, and we lost financing. It was supposed to start October 1st, 2008. And then the recession and all the lending, the banks started. Yeah. The end of that run started 2 weeks before we were supposed to start construction, and I had to figure out what to do next, Brian. To be honest with you.
So that's 08, and so how'd you find these partners? So, or in your role, I guess, was the design, the civil engineering, all the stuff you were good at. They were probably good at raising money, and then you had the design guy. And then that's kind of how you assembled this first team was assembled?
Correct. My niche was really entitlements and getting challenging projects approved. As I mentioned,
to rezone. But entitle means just to rezone something, right?
Correct.
To change the use of it.
Secure all the approvals, to design it, to get the community involved, and to build it. And usually in a municipality, you're getting approvals from a planning commission board. And then if you can secure that vote of approval, you'll move forward to a city council level or county council, board of supervisors type approval. And then you have the planning approvals, the use approvals to move forward and build your and secure your building permits to start construction.
Yep. And it seems like it's probably a highly valuable skill because there's probably all these intricacies that these guys don't know. Maybe they're good at raising money or they're good at construction, but if they don't get the plot of land for the right use, there's nothing they can do, right? And I'm sure that's probably your skill set, right? And shining value that you're bringing. What it sounds like.
Because you can't count it for granted, right? There are some locations, municipalities, states where you could stick a shovel in the ground tomorrow and no one will stop you, but that's rare.
Yeah. And the good properties, the beachfront property, or the stuff that's probably you really want to, that has the highest value add, is probably needs this process. Is what it sounds like.
Yeah, and it's challenging. I rarely invest outside of my business in multifamily, but I actually recently invested in a sexy Kelly Slater surf park residential development in Palm Springs and La Quinta. And I wasn't involved with it at all, but the project got outright denied. And those guys are gonna have to figure out how to exit or sell that land to someone else because that project did not get approved. So projects don't always get approved as they're initially proposed.
Yeah. So it's 08. You're down on your luck there. Then what happens next? How you start to rebuild this thing?
Well, as Warren Buffett says, buy when there's blood in the streets, right? And there is a lot of blood in 2008, 2009. It was, as we call the closest thing to a real estate recession. Almost everything failed. It didn't matter the asset type. Projects were going back to the bank. And I had done a little bit of everything, right? From single family homes to commercial to retail to buying some of my own properties to wanting to go out on my own. And I really saw it as a phenomenal opportunity. So I spent the time really researching what was next, right? What was the next smart contrarian investment in real estate? And I wanted to build a sustainable real estate model, which those two words don't always go hand in hand when it comes to real estate.
Yep.
A lot of people laugh at me when I said that. But I found multifamily and in the security and risk adversity that comes with multifamily. And as much as, the Great Recession was a real estate recession, most people don't know this, the percentage of apartments that went back to the bank was something like 0.3 to 0.4, 0.5%. They simply were not the type of real estate that went back to the bank. And in looking back, we've seen that, right? So I started buying apartments in 2009 that were 99 to 100% occupied. And I had sellers that were in a lot of distress somewhere else. Maybe they were in development. Maybe they owned condos in South Florida or Southern California. And their distress was forcing them to sell their really cash cow apartments at a discount. And that was really the beginning of buying apartments. Now, coming out of development, Brian, I had lost pretty much everything. I was newly married, had a baby on the way, and I had put everything into my development business. And when that project didn't kick off and start construction, I essentially lost everything. I remember looking at my bank account and seeing a little over $1,700 and really just digging in and trying to figure out what was next. So it was a scary, crazy time. And then I really just started buying smart, well-located apartments at the bottom of the recession and doing, one good deal a year. And good deals are really hard to find. I always say you have to look at 100 deals to dig in on 50, to maybe write 20 offers, to maybe be competitive on 5, to get one really good deal for you and your investors. And people often ask, hey, how did what's the secret sauce, right? The silver lining. How did you build
100? Look it up. Do 100 deals.
Yeah, 7,000 units and $1 billion plus. It's looking at a lot of opportunities. It's doing, as I said, really one good deal a year, one smart deal for your investors, and taking care of them first and delivering to them first, where they spread the word. And not only do they want to invest in the next deal, right? They often will bring 2 or 3 of their friends. Yep. And of course, building the right team. I've had a phenomenal partner. I've had phenomenal teammates that have been with me for 10 plus years, and we've built this together. Yeah,
awesome. So I want to go back to, so you had $1,700 in the bank account, right? And then, walk me through, like, I don't know, a lot of people will be like, oh, well, I gotta go get a job, right? Like, and sounds like you had this approach of, I need to go buy a building. And so I guess talk to me, how do you finance that? Did you bring in partners? Like, talk to me some of the specifics on how you kind of got from that moment to closing that first deal.
And it was really hard not to go back and get a job, Brian, right?
Oh, I would imagine. Yeah. I had an new baby degree.
I had an MBA. I know I could go back and get a good, probably high paying job at that time.
Yeah.
I had caught the entrepreneurial bug, right? And don't get me wrong, I had the resume all ready to fire it out to some groups. I was looking at that. I remember my mom telling me I should become a bartender in the evenings to bring some money in.
Yeah.
I remember telling my father that I was unemployable, and he did not like that. And, what I meant by unemployable was, hey, I was determined to do this on my own. I didn't know that I could go back. I didn't think I wanted to. I knew I did not want to go back and work for someone else.
Yep.
So as ugly as it was, I wanted to really blaze my own path.
Yeah. I hear that. That's a similar story I hear from other guys who, they have really good high paying W-2 jobs, in corporate America, and they want to go start their own business. Right. So they're kind of on the opposite side. They want to transition in. And one of the, I don't know, and I've never been there, right? I've kind of always been on just in my family business and growing it. But for them, they're very employable people. If the business doesn't work out, they have all these connections and network and a great resume. And so it's the worst thing that's happens is they have to go get a job again, right? Where the best thing that's happens is now they own this business and they can grow it and scale it and make it as big as they want it. $1 billion under management, right? It's kind of this, you weigh the risk reward. And when you really break it down, most people aren't going to end up on the streets. They're not going to whatever, like these worst case scenarios that are in our mind, for most people, like they're very employable people and can easily get a job if they wanted to. And they may hate it and they may want to get back into the race again, but it's like, I don't know. It's the risk reward ratio for sometimes it's the risk or the rewards can be way better than the risk that it takes. So I don't know. It sounds like you had pretty much the same thing, just on the opposite side of, hey, I could go do this, right? Because you were that guy, but decided instead of going back, like, let me give this thing one more shot. Is that?
I think, I think it's time and place. I remember going to seminars and reading books, and everyone has a rags to riches, story from failure to success. And I remember rolling my eyes at that, going, gosh, that's not going to be me. Those are fairy tales, right? And sure enough, it's a big part of my success, right? The biggest failure is essentially the biggest success. I look back at losing everything and look back at that recession and go, it was the best thing that ever happened to me. You don't wish anyone to go through that period of time. It's funny. I don't remember a lot of the stress that I'm sure I went through.
Oh yeah.
And as I said, you don't want to put anyone in that position, but often when you're put in that position, the sink or swim, folks are going to swim, right? And
I heard a great quote. It's from this author, Steve Sims. It's this book called Blue Fishing. I got him coming on the podcast in a couple of weeks, but he has this quote from his book, and it says, "You don't drown by falling in the water. Like, you drown by staying in the water." And you fall in, and you have your failures and your challenges, but like, it's the ones who stay there and dwell on it versus the ones that move forward and get out. And so that means exactly.
And a lot of that's a positive attitude, right? Belief in yourself, like simple things our parents have been telling us since we were babies.
Yep.
But it's so true, right? I was blessed to have a wonderful upbringing, and two parents who were married and always there for me. And maybe that had something to do with it. I'm sure it did. But I was one of these guys where I always, if I jumped off the cliff, I always knew I was going to land on my feet.
Yep.
Right. That was just always me. And even if I jumped and landed on my head, I knew somehow, some way I was going to learn from it and end up back on my feet. That's always been my mentality, where I kind of not thrive in the downturns and thrive in the negative, but I've been around long enough, Brian, to realize it normally puts me in a really good spot coming out of it.
Yeah, and that's great advice. And I think I've learned the same over the last few years, is that like every challenge or quote failure is really just a learning opportunity. Like, you learned what didn't work. Like, you learned what you shouldn't do. You learned the type of deals you should invest in, or the people you should partner with, or the business models, or whatever it is, right? And I think if someone goes at about that approach of, what did I learn from the situation and how can this improve my life? This is the same exact scenario that happened to someone else who then just they dwell on it. They stay in the water and woe is me and the victim and all that stuff. It's and it's a differentiator, right, between the successful people like yourself and the thousands of other people who are in the exact same scenario as you and chose a different path. So I think it's great. So let's get back to, I want to hear about the story though. So you got the first deal. Like, how'd you finance it? You found it, or it sounds like, did you have partners and friends?
It's funny. I didn't even find my first deal. So I was on, a website where folks were posting opportunities, and
like a Bigger Pockets or whatever it was.
Exactly. Very similar to that at the time. And there was an opportunity, and I give the gentleman credit because I could tell he thought like me, and I'm an engineer by trade, very black and white. I like to dot my I's, cross my T's. I'm not crazy aggressive. I don't move super fast. But this gentleman had laid it out. He had a deal under contract. Here are the high points, the pros and cons. It was an 80-unit property called Windchase Apartments. It's probably still there in Odessa, Texas.
Okay.
And the returns looked realistic, and I reached out to him. He had it under contract. He was getting ready to go non-refundable, hard with some dollars. I think he was nervous.
Do you remember how much? Do you remember how much it was?
It wasn't. Well, it was back then, right?
Yeah.
I don't remember how much it was. Maybe it was $100. Let's say it's called $100,000 plus or minus.
Oh, wow.
And
That for 80 units occupied?
For 80 units occupied. Yep.
Okay.
And it was at a 9 cap.
Okay.
For those of you who've been following cap rates over the last 10 years, we buy 8 and 9 caps back then. But this is Odessa, Texas, right? So it's a tertiary market.
All right. So it's like whatever it is, 80 units. This guy's got this thing posted. He found the deal. He's got it under contract. And then what happened? He
needed help raising capital, right? I was looking for my own deals.
Yeah.
I wasn't looking to partner, but I like the metrics. I like the story, the story of the deal. Mismanaged property, well located, right across the street from UT Odessa campus.
Okay.
Right next to the mall, walking distance to the movies, B class, built in the 80s, pitched
so
roof.
It's checking all the boxes.
2-bedroom, 2-bath units, in-unit washer dryers. It checked all my boxes, which is very hard.
And you and the guy click because you're both engineers. Right. And then
he needed help raising capital. So he had raised, I think we needed $1.5 million plus or minus. And he said, hey, I've raised half. Can you raise, the second half? And I said, sure, let's do it. So we went in, and I remember it was about 4 days before we had to wire in a rate lock, another non-refundable deposit of about $80,000. And he calls me and says, hey, Mike, that $750,000 I thought I had raised, I only have $200,000. and now my money is hard alongside of his, right?
Yeah. Yeah.
I remember that 4 or 5 day period being pretty stressed out. I had raised my, $750,000. And he had gone backwards, right?
Yeah. So now you need another 500, 550.
We needed another 550 in 4 days, or this deal was going to go sideways, or we were going to potentially lose our deposits. And we were able to make it happen. I had some investors step up. I had a relationship with another gentleman that had success raising capital. And, he has now been my partner for 13 years. But he hopped on a plane, he flew out, and in 4 days we resurrected this thing. He put some money in, brought some of his investors, and got a great deal closed. And then, as I said, this is a business of volume. You have to look. We're not in the retail business of buying value add multifamily apartments. You have to look at a lot of deals. So the next deal didn't come till the next year. But it was a big one. It was the 232 unit deal, Brian. It was right across the street from the first one.
Oh, man. Perfect.
And we were getting, I still have investors sending me the old distribution letters, because investors were getting 16 to 18% yield, cash on cash returns.
Oh, wow.
On these deals.
And were you making money on it, like enough to support your, family? On this first one, because you had a year before you did anything, right? It's
a great question, right? So you close your first apartment building. It's a $5.2 million apartment building, and you want to celebrate, right? You get a little acquisition fee. You're investing in it. You've got happy investors who are getting great returns. You're getting, promote your share of the cash flow. But as a guy that had lost everything and was newly married with a baby and another one on the way at that time, no, Brian, it did not create a level of comfort.
That's what I thought. Yeah. So what'd you do? I
congratulated myself for about 30 minutes, and then the stress level kicked in. But you do go through that, right? You close your first deal and you're like, okay, I figured it out. I've got it. I've made it. It's not the case.
Yeah.
You need to keep that drive for years and years and years, right? The success comes from doing it over and over and over again.
So then so that was 09, right? 09.
What's that, Brian?
09, 010. When you bought this one?
09. It was the summer of 09.
Okay.
I think August of 09 was the first deal. Next deal was about 12 months later. Okay.
And then so it probably looked like something from that point to today is some sort of exponential graph, I'm assuming, where it kind of starts slow. You do one and one, but then you start trading up and doing bigger and bigger deals.
Yeah, correct. I think for the first 3 years, I just did one deal a year. And then maybe it was 2 deals a year, and then 3 deals a year, and then 2 deals a year, and then 4 deals a year, and then 5 deals a year. Last year we did 7 deals. Yep. So there is that exponential growth, but it comes, as I said, from doing, being very picky, patient, and prudent about our investments and delivering to investors.
And then what's the strategy? Is it is it a lot of the 5 to 7 year plans where you're buying, you add value and then you sell it? Or is it kind of the buy, hold, refinance, cash flow? Like, I know there's different theories on it. Like, what's your approach, or does it vary per property?
We've done a little bit of everything. And over the last couple of years, it's varied per property, where we've done some 10-year holds and we've done some heavy value adds, 3-year holds. But I really believe that apartments are about long-term holds and long-term wealth. So I prefer the 7 to 10-year holds, which is traditionally what we've done. Still heavy value add, where we're generating all the appreciation and all the value in the first 2 to 4 years, right? Okay. We're investing $3 to $6 million into improving the interiors of the apartments and spicing up the amenities and paint and fixtures and eliminating deferred maintenance and rebranding the property with new signage. This first 3-4 years is where you create all the value growth and appreciation. So we always have 2 exit strategies. One is to sell at that point in time, once we're done with value add. Or 2 is to hold on long-term and reap the benefits of all that work from a cash flow and tax advantage standpoint. And we often will refinance in years 3, 4, 5
to pull some of that equity out.
50 to 80% or 100% of the investor's capital back. And then their return is infinite, right? And then we'll hold on to that property long-term for cash flow. That's my preferred hold strategy, because, lock in at a great fixed rate, whether it's high or whether it's low. But over 10 years, you ride through the hurdles, the ups and downs. You typically generate or benefit from tremendous rent growth and tax advantages. And over 10 years, you're ready to refinance, return everyone's capital back, and hold on to a really good asset for cash flow.
So on a personal level, for you, do you, like, obviously you invest in all your deals? Are there other like buildings that you're buying like just on your own that you're going to hold forever, or like, do you just have a plan of once you're kind of hang up the hat, you'll just deploy your capital with other guys doing a similar business plan? Or what does all that look like from like your perspective?
It's funny, Brian, I get that question a lot. And it's one I know the answer to. It's been pretty, I think it's different from what most people expect, but I don't really look at deals as something I would want to buy on my own. We have a very loyal following of investors. Most of our investors have been with me for, they're in 8 to 20 deals, Brian.
Oh, wow.
Right? Them and their family have been investing with me and my partner for 5 to 10 years, right? And they've had a great experience, so they keep coming back, right? Yep. They're diversifying their wealth, their dollars into our investments. So I have this loyalty, right, to those who got me here, and I'm very close with them, and vice versa. We often communicate through thick and thin with our investors. So when I find a good deal, I really, maybe just because I've been doing it for so long this way, Brian, but I want to do it with investors.
Okay.
And the men and women who have trusted us through the years. And
the size and scale, like, it makes sense to wrap a big deal into your big company versus like you doing some small thing that you have to like directly manage. And I don't know, for me, that would make sense too, to just part of the company, right? And then
I had a broker this week call me with a small 12-unit deal. We bought 2 deals from him in the past, so we have that trust and track record with him, right? Seller was a little distressed, needed a quick sale. And he said, hey, I know who can buy this, really easy. And I think it would have been a great buy. But, sometimes you gotta kick yourself and remind yourself, hey, what got us here was buying, 80 to 500 unit size deals where you get great economies of scale, great management, great leasing, etc.
Yep.
And sometimes the smaller deals, Brian, through the years, at least for me personally, can create some headaches. There's a little bit more risk. You don't get as great management, and they can be as much time, if not more. You were alluding to it, than a 400 unit property.
Yep, I've done it with the one-off. This for me, it's the single family home or whatever it is, and just becomes more of a headache.
And I tell this story all the time. A lot of people start there. I started there, right? And a lot of my investors, still do that and diversify. And many of them learn the same lesson that I did, is with managing assets, especially small asset, it's a lot of work, right? Whether you're doing it yourself.
Like, it's not really an investment. It's kind of like a job. But it's like a great learning experience. You get your feet wet with it. And then you graduate, right? I mean, that's okay. Like, it doesn't, there's nothing wrong with that. Or you stay there, and if
you're dealing with a management company, right? You might have a mom and pop management company. It might be, as you said, one single family home or one duplex, and you don't know, do they come by your property once a month, once a week, once a year, once a decade, right? I mean, there's a lot of risk in that. The larger properties, right? You have full-time staff of 3 to 10 people, and their full-time job, W-2 job, is to protect your investment, right? And many of them live on the property, and they're incentivized to help your investment and your property perform on a daily basis. Yeah,
it's awesome. So my final question, or second to final. So with all the economic stuff going on now, I'm sure you get this all the time, but like, what are your thoughts on where the real estate market's heading, the economy, and like, what are you guys doing to protect yourself and the capital?
Yeah, it's a crazy time, right? We've been blessed with having done great deals, well-performing deals, happy investors, and most of our portfolio is with low fixed rate debt. So we're in a great position.
You're fine either way. Interest rates go to 9-10%. You lock it in 4 or 5 years, or do you get longer than that period?
Well, traditionally we've done 7 to 10 year fixed rate debt.
So a lot of your debt now is 7 to 10.
Yeah,
that's awesome. Yeah, so like that. So you can withstand. It doesn't even matter what the interest rates are, right? Because you've got it locked. As long as people are paying rent, it's the performance should stay consistent.
And as I mentioned earlier, with the 10-year horizon, it gives you the ability to ride through these ups and downs. So when I first bought those 2 deals in Odessa, Texas in 2009 and 2010, interest rates were 5.25% to 5.5%. Not too far from where they are right now.
Yeah.
So the ability to buy a really smart, well-managed asset with good debt and hold on to it.
So what's the opportunity that I guess you're looking out for that other people should be aware of? I would imagine it's these guys who have floating rate debts, and the thing becomes upside down pretty quickly. Is that what you're on the lookout for now?
I think it's 2 things. So what are we, I always say we're picky, patient, and prudent, but we especially are right now. We're kind of waiting in the wings to buy 2 things. One, higher cap rate deals and positive leverage deals, meaning you've got a good delta between the cap rate and the interest rate, right? Over the last couple of years, many of us in our industry have been buying negative leverage deals, right? With cap rates dropping below where interest rates have been. So I find this as a great period of opportunity to start buying some great, well-located, higher cap rate deals. And then number 2, to your point, Brian, I think there will be some distress. There's a lot of our competitors that have been buying with variable rate loans, and some of them will do just fine. Some of them, if they didn't buy interest rate cap, we did 5 variable rate loans over the last 12 months. But we bought a 1% interest rate cap that essentially fixes our interest rate on any given deal between like 3.7 and 4.2%. So we've protected ourselves, but there's a lot of groups that haven't. And I think we'll see some really good buying opportunities over the next few years, Brian.
Okay. And where do you see the company going? You got 1.3 now, like in 5 years, what's it look like? Do you have a goal?
I think I'm not the greatest goal setter, Brian, but I'm a deal junkie, right?
Yeah.
So I haven't changed much from the beginning. It's doing one good deal a year, right? And if we have a year where we don't do a deal, are we going to be okay with that? Absolutely. So it goes back to that, right? The ability to find and manage and raise capital for one good deal a year. And ideally, if we can do 2 to 4 deals a year for our investors, great. My partner and I, we personally invest in each and every deal. So we're not out there, doing deals just to do deals. So if it's one great deal a year, great. If it's 4 or 5, fantastic.
That's awesome. Yeah. So where can listeners connect if they like to learn more about you personally or the company, or they're interested in, looking at any of your deals? Where can they find you?
Yeah, happy to share. I'm pretty open book. I tell my investors, text me in the middle of the night. I'll call you back in the morning. But website is l5invest.com. And Brian, can you distribute my email, or should I just share it here now?
Both. We can add to the show notes as well. But yeah,
okay.
We'll talk about it.
Yeah, I mean, the email is just Mike, Mike, at L5invest. Capital L as in Larry, the numeral 5 and the word invest.com. And my number is 310-991-3091. Call or text. And if you have interest in partnership or investing, or just want to learn more, feel free to reach out to me.
Awesome. Cool. I appreciate you coming on and sharing your story. It's pretty, inspiring. I think, kind of the ups and downs and kind of picking yourself off your feet and really kind of building an awesome company and adding a lot of value to your investors and to your residents and just kind of building this really good community. So good
Thanks,
job.
Brian.
And it's been awesome chatting with you.
Appreciate it. Thanks for having me, man.
All right. I'll see you. That's all we got for this episode with the Business with Beers podcast. One thing that would really help both us and other new potential listeners is to rate the show and leave a comment in iTunes, Stitcher, wherever you listen. Also, make sure to link up with me on your preferred social media platforms, LinkedIn, Instagram, Twitter, Facebook. You can find all my links at brianbeers.com. Please just share the podcast with anyone who you think might enjoy it. And until next time, remember to take the actions others won't, to live the life that others don't.